Investment Insurance, Business Studies, Grade 12. Let's dive into this topic. Hi there, my name is Teacher Ilona. If you're new to my channel, welcome to my channel. To my subscribers, welcome back to my channel. In today's video, we are going through Investment Insurance for Business Studies Grade 12. I really hope that the June exams are going well. For those that have written their exams already, I really hope that it went smoothly and that my videos have helped for the June exams. I want to thank you guys all again for all the support and for all the watch time, all the views, all the likes, and all the subscribes. It really means a lot to me, and I really can see how my channel is growing. In today's video, I will be making use of slides, which I do not take credit for. I've received this information on the Western Cape Education website, where I have received notes, and there are mini learner textbooks that you are welcome to download. They are free of charge. When you download them, you will see all activities and they explain all the information in detail. I've made use of this information as is to make sure that my information is relevant, accurate, up-to-date, and correct for Business Studies Grade 12. So, without further ado, let's dive in. Investment Insurance. Right, the meaning of insurance. Insurance refers to cover for a possible event that may cause a specific loss or damage. An agreement whereby the insurer undertakes the indemnity the insured in the event of the specified loss or damage. The insured has to pay a premium for specified loss or damages covered. A contract between a person, business, or insured requiring insurance cover, an insurance company, insurer bearing the financial risks. Then we have non-compulsory insurance. The meaning of non-compulsory insurance. Non-compulsory insurance is voluntary. The insured has a choice whether to enter into the contract. It is not required by law, but it can provide protection for a business and individuals. It is taken out in order to transfer the risk of something happening onto the insurance company. So, for example, if we have a tree that falls down onto our building, right? We didn't know that was going to happen. We can't necessarily plan for such an event, and that's where insurance comes in. But non-compulsory is where it's not required by law, but for us as a company, we have decided to take this out in case of such events. Earthquakes can happen. There can be fires. There can also be theft and stealing, which can also occur. I mean, if there's a robbery as well, those things we can't really prevent, and insurance may cover for such events. These risks include, like I mentioned, theft, damaged cars, damaged buildings, premises, injuries on premises. Non-compulsory insurance can be divided into short term, so we're looking at fire and theft, and then long term, which is like retirement or death. The meaning of insurance concepts. Overinsurance. Overinsurance is when the item is insured for more than the actual market value. Businesses will not receive a payout larger than the value of the loss at market value. This means that the extra money paid for the premiums will not be paid out to the insurer if there is a claim for a loss. Underinsurance occurs when property or assets are insured for their full market value. The property or asset is insured for less than the current or actual value of the property or asset. If a business is insured for an amount that is under the actual market value of the goods or services, the business will only be paid out the amount that the goods or services are insured for. The insurer usually applies the average clause to calculate the amount of money that must be compensated to the insured if the goods and services are underinsured. Then we have average clause. This is a stipulation set by the insurer which is applicable when property or goods is underinsured for less than its market value. The insurer will pay for insured loss or damages in proportion to the insured value. This means that the insured is responsible for a part of the risk that is not insured. Then we've got a formula for calculating the average clause. Before we dive into it, let's read that quickly. The insured amount is divided by the market value of the insured item and multiplied by the total value or amount of the damages or loss. Insurance companies apply the following formula to determine the amount to be paid out to the insured. There's our formula. So we've got amount insured divided by market value times the damages. All right, so the amount insured times the amount of damages and then the value of the insured item. So, example of calculating the average clause. Peter owns a thatched house valued at 1 million. He insured his house with Pro Cover insurers for 800,000. A fire in the kitchen caused damages of 30,000. Calculate the amount that Pro Cover's insurers will pay Peter to cover the damages. Then we need to explain to Peter the reason why he did not qualify for the full amount of damages sustained. So, we're going to take our insured amount, which is our 800,000, times by 30,000, which is our damages. Then we're going to divide this by the 1 million, which the house is valued at market value. And that gives us a total of 24,000. So that is the amount that he will be paid to cover the damages. Now on the next one, we need to explain why he didn't qualify for the full amount. Because we can see there's a 6,000 Rand shortage there to cover the full amount. All right, so reason why he did not qualify. Peter insured his house for less than the market value. So he's only insuring his house for 800,000. Meanwhile, his house is valued at 1 million. He was underinsured, so the average clause had to be activated. He will only receive 24,000 for damages and not the full amount of the claim, which is the 30,000. Reinstatement. It is a stipulation whereby the insurer may replace lost, damaged property or goods instead of reimbursing the insured. The stipulation is applicable when property or goods are overinsured. The reinstatement value will not be higher than the market value for the loss. Insured is returned to almost the same financial position as before the losses were occurred. So an example of this, a business property that has been insured for 300,000. But the market value of the property is only 200,000. Already there you can see we are over-insuring this. If it is destroyed by fire or a storm, the insurer will rebuild the property instead of paying the cash. Differences between over and under insurance. So, already by the words we can already tell which one's which. So, overinsurance, the property or asset that is insured for more than their value, okay, like the house in the previous example. The insurer can choose to reinstate the insured, again, like the previous example. Businesses will not receive a payout larger than the value of the loss at market value. So like with the previous one, the house was only valued at 200,000, all right? But they insured the house for 300,000. So should there be damages, then only 200,000 will be paid out, not the 300,000. So remembering at market value. Under insurance, property or assets that are not insured for their full market value. The insurer will implement the average clause to determine the amount that will be paid. Businesses will only be paid out for the amount that the goods or services are insured for. Then, differences between insurance and assurance. Remembering with overinsurance and underinsurance, very nice question that they like to ask, the differences between the two. Insurance and assurance, also differences between the two. So just make sure that you remember them. Insurance is based on the principle of indemnity. The insured transfers the cost of potential loss to the insurer at a premium. It covers a specific event that may occur, applicable to short-term insurance. So examples here are property insurance, money in transit, theft, burglary, or a fire. Then assurance. Based on the principle of security or certainty, the insurer undertakes to pay an agreed sum of money after a certain period has expired or on the death of the insured person, whichever occurs first. It's a specified event is certainty, but the time of the event is uncertain. This is applicable for long-term insurance. So here we're looking at life insurance, endowment policies, retirement annuities. So with the fire, we don't know when the fire is going to occur. We don't know if the fire is going to occur, right? But when it comes to assurance, we know that at some point we are all going to pass away. But we just don't know when it is going to happen. So in that way, we need life insurance. We need a funeral plan, for example. Even the retirement, we all know that at some age, everyone retires. So this is the difference between the two. Then, examples of short-term and long-term insurance. Short-term insurance, property insurance, money in transit, theft, burglary, or fire. Long-term insurance, endowment policy, life cover policy or life insurance, retirement annuity, pension fund, provident fund, disability policy, trauma insurance, funeral insurance, health insurance, or medical aid. Then the principles of insurance. So here we have indemnification, security, utmost good faith, and insurable interest. Nice little diagram that you can just jot down. So indemnification or indemnity usually applies to short-term insurance as the insured is compensated for a specific proven harm or loss. Insurer agrees to compensate the insured for damages or losses specified in the insurance contract in return for premiums paid by the insured to the insurer. It protects the insured against the specified event that may occur. Payouts from insurance companies or insurer will only be made if there is proof that the specific event took place, if the insured can prove the amount of loss or damage. So if a fire has occurred, proving that there has been loss or damage. If one of the company vehicles has gotten into an accident, taking photos of the car and taking photos of the damage. Also going to a mechanic or a panel beater to go and assess the rand value of those damages. That's what they're referring to there for the proof. The amount of indemnification or compensation is limited to the amount of provable loss or damage, even if the amount in the policy or contract is higher. The insured must be placed in the same position as before the occurrence of the loss or damage. The insured may not profit from the insurance. Security or certainty applies to long-term insurance where the insurer undertakes to pay out on an agreed amount in the event of loss of life. So if someone has passed away, a predetermined amount will be paid out when the insured reaches a predetermined age or gets injured due to a predetermined event. Aims to provide financial security to the insured at retirement, the dependents of the deceased. Utmost good faith. Insured has to be honest in supplying details when entering in an insurance contract. Both parties or insurer and insured must disclose all relevant facts. Insured must disclose everything that may affect the extent of the risk. Details or information supplied when claiming should be accurate. So for example, if going for a medical aid, which is our long-term insurance, there we need to disclose any health issues that we've had. What operations have we had? What are we allergic to? What health, maybe we've got a heart condition. Perhaps we have asthma. Perhaps we have high blood sugar, low blood sugar, those type of things. So utmost good faith is referring to disclosing all of that type of information upon which, as I said, the extent of the risk will be evaluated and analyzed. Insurable interest. Insured must prove that he or she will suffer a financial loss if the insured object is damaged, lost, ceases to exist. An insurable interest must be expressed in financial terms. Insured must have a legal relationship with the insured object in the contract. So here we're looking at if you are insuring a car, or you're insuring maybe your wedding ring or stuff like that. As it mentions there, if the object is damaged, lost, or ceases to exist, that there will be financial losses involved there. Advantages or the importance of insurance for businesses. It transfers the risk from the business or the insured to the insurance company or insurer. In that way, it also provides, I guess, safety and a bit of comfort for the business, knowing that should something go wrong, they do have these insurance policies in place that can cover for theft and damage and even fires. Even floods can damage a lot of the stock. So by transferring that risk to the insurance company. Transfer of risk is subject to the terms and conditions of the insurance contract. It protects businesses against dishonest employees. It protects businesses against losses due to death of a debtor. So a debtor is someone who owes the business money. So if that person passes away, that money is lost, not if we have insurance in place. It protects the business against theft, loss of stock, and or damages caused by natural disasters such as floods, storm damage. It protects businesses from claims made by members of the public for damages that the business is responsible for. Businesses will be compensated for insurable losses, destruction of property through fire. Businesses' assets, like example, vehicles, equipment, and buildings, need to be insured against damage and or theft. We had an earthquake here in Gauteng in South Africa not so long ago, and that could have caused some significant damage. Luckily it didn't, but if we have natural disasters such as that, and there are cracks in our building, then we could experience some issues there. But if we have insurance, at least we are covered for that. Businesses are protected against the loss of earnings. Example, strikes by employees, which results in losses worth millions. Life insurance can be taken out on the life of partners in a partnership to prevent unexpected loss of capital. Should the services of key personnel be lost due to accident or death, the proceeds of an insurance policy can be paid out to the business or beneficiaries. Replacement costs for damaged machinery equipment are very high. Therefore, insurance can reduce the losses and the costs thereof. Meaning of insurable or non-insurable risks. Insurable risks, meaning these risks are insured by insurance companies. Insurance companies decide on the likelihood of an event and then decide if they want to insure the risk. Meaning of non-insurable risks. These risks are not insured by the insurance companies as insurance costs or risks. They are too high and it remains the business's responsibility. The insurance company cannot calculate the profitability of the risk and therefore they cannot work out a premium that the business must pay. Then we have examples of insurable versus non-insurable risks. So insurable, they were looking at theft, fidelity insurance, burglary, money in transit, fire, natural disasters like storm, wind, rain, hail. Damage to loss of assets, vehicles, equipment, building and premises, and injuries on premises. Then we're looking at non-insurable risks. Nuclear weapons or war. Unfortunately, non-insurable risks. Changes in fashion. So perhaps I've started a company where I am selling, headscarves, and it goes out of fashion because there's something new that comes out. It's a non-insurable risk because fashion changes all the time. I'm sure we all know that. Improvements or changes in technology, same thing. Irrecoverable debts, financial losses due to bad management, possible failure of a business, shoplifting during business hours. That one's a bit of a pity. Loss of income if stock is not received in time, the time that lapses between ordering and delivering of those goods. Of compulsory insurance. Compulsory insurance is insurance that is required by law before businesses or individuals may engage in certain activities. Compulsory insurance is intended to safeguard the welfare of everyone concerned. It is regulated by the government and does not require insurance contracts or brokers. Payment in the form of a levy or contribution paid into a common fund from which benefits may be claimed under certain conditions. Types of compulsory insurance. There we're looking at the UIF, Unemployment Insurance Fund, Road Accident Fund, Road Accident Benefit Scheme, and of course, you guys know COIDA, Compensation Fund for the Compensation of Occupational Injuries and Diseases Act. The Unemployment Insurance Fund, UIF. The UIF provides benefits to workers who have been working and become unemployed for various reasons. Employees contribute 1% of their basic wage to UIF. Businesses contribute 1% of their basic wage to UIF, therefore reducing the expense of providing UIF benefits themselves. The contribution of businesses towards UIF increases the amount paid out to employees that become unemployed. All employees who work at least 24 hours per month are required to be registered for UIF and need to contribute towards UIF. It is an affordable contribution that makes it possible for businesses to appoint substitute workers in some instances. The business cannot be held responsible for unemployment cover as the UIF pays out the contributors directly or dependents of deceased contributors. Businesses are compelled to register their employees with the fund and to pay contributions to the fund. The UIF benefits. There's unemployment benefits, illness or disability benefits, maternity benefits, adoption, and dependent benefits. Unemployment benefits. Employees who become unemployed or retrenched due to restructuring or an expired contract may claim within 6 months after being unemployed. Unemployed employees may only claim if they have contributed to UIF. Unemployed employees enjoy these benefits until the allocated funds are exhausted. If a worker voluntarily terminates his or her contract, then he or she may not claim. No tax is payable on unemployment benefits. Illness benefits, sickness and disability. Employees may receive these benefits if they are unable to work for more than 14 days without receiving a salary or part of their salary. Employees may not claim these benefits if they refuse medical treatment. Very important there, I believe. Maternity benefits. Pregnant employees receive these benefits for up to 4 consecutive months. If an employee has a miscarriage, she can claim for up to 6 weeks or 42 days. Adoption benefits. Employees may receive these benefits if they adopt a child younger than 2 years old. Employees who take unpaid leave or may receive part of their salary while caring for the child at home. Only one parent or partner may claim. Dependents benefits. Dependents may apply for these benefits if the breadwinner who has contributed to UIF dies. The spouse of the deceased may claim whether he or she is employed or not. Road Accident Fund or Road Accident Benefit Scheme. The Road Accident Fund or Road Accident Benefit Scheme insures road users against the negligence of other road users. The fund provides compulsory cover for all road users in South Africa, which includes South African businesses. Drivers of business vehicles are indemnified against claims by persons injured in vehicle accidents. The fund is funded by a levy on the sale of fuel, diesel, and petrol. The amount that can be claimed for the loss is limited by legislation. The next of kin or breadwinners who is injured or killed in road accidents may claim directly from this fund. The injured parties and negligent drivers are both covered by this fund. The insured party will be compensated irrespective of whether the negligent driver is rich, poor, insured, or underinsured. The fund aims to provide a benefit scheme that is reasonable, equitable, affordable, and sustainable. This fund aims to simplify or speed up the claims or processes as victims of road accidents no longer have to prove who caused the accidents. The fund enables road accident victims speedy access to medical care as delays due to investigation into accidents has been minimized. The Compensation Fund, so COIDA. The fund covers occupational diseases and workplace injuries, compensates employees for injuries and diseases incurred at work. Compensation paid to predetermined Compensation is paid by the degree of the disablements. The contribution payable is reviewed every few years according to the risk associated with that type of work. So your construction workers and people working with harmful chemicals, they review this every few years to look at the risk that's associated. All employers are obligated to register with the compensation fund so that employees may be compensated for accidents and diseases sustained in the workplace. The fund covers employers for any legal claim that workers may bring against them. Employers are required to report all accidents within 7 days and occupational diseases within 14 days to the Compensation Commissioner. Employers are responsible for contributing towards the fund and may not claim money back from the employees or deduct contributions from their wages. In the event of death of an employee as a result of work-related accident or disease, his or her dependents will receive financial support. Employees do not have to contribute towards this fund. It's the employers. Employees receive medical assistance provided there is no other party or medical fund involved. Differences between compulsory and non-compulsory insurance. I know we discussed this a bit later. This is just a bit of extra information. So, compulsory insurance is required by law. There are legal obligations for it to be taken out and paid for. It is regulated by the government and it does not require insurance contracts or brokers. Payments in the form of a levy or contributions paid into a common fund for which benefits may be claimed under certain conditions. Examples is UIF, the Road Accident Fund, and COIDA. Non-compulsory, as we mentioned, I'm going to go through this quite quickly because we already went through this. So it's voluntary. You choose whether you want to be in the contract or not. The insured will enter into the legal contract with the insurer, who may be represented by an insurance broker. There is a monthly or annual payment or premium that must be paid in order to enjoy the cover for a nominated risk. So short-term insurance, multi-peril insurance, so theft and fire, as well as long-term insurance and life insurance. Here's a nice little mind map, just with the bite-sized bits of information that you can go through and read through here for this topic of insurance. And the second mind map on this slide as well, you can see there's just continuing with some of the information we've gone through. And here are the resources that I've made to make these slides for this video. And I have made use of these resources as well as in my explanations. And as I mentioned, I do not take any credit for the information I've given. I've given it as is and haven't changed a thing to make sure that it's accurate and relevant for the grade 12s. Thank you so much for watching my video today. I wish you guys all the best. This is the last week of exams and the last week of school. So I know that it's going to be a bit more chilled on my channel. There's been a huge volume and a lot of views and subscribers in the last few weeks due to the June exams. But I cannot wait to see you guys again next term. As I mentioned before, I will be uploading during the holiday just to add in some extra videos and to remain consistent because that's important as a YouTuber. But I wish you guys all the very best with the last week. May you enjoy the holidays. And again, thank you for all the support. If you like this video, please hit the like button and please consider subscribing to my channel if you're a business studies student that needs extra help, extra guidance, and would like to watch some videos as revision for tests and exams. Thank you guys, and I can't wait to see you guys in my next video. Bye for now.